So far, we've talked about what an annuity is, who would buy one, as well as the pros and cons of buying an annuity. Today's video will focus on the different types of annuities out there: fixed, indexed, and variable annuities. For our loyal subscribers and viewers, welcome back. We love you guys. And for those of you new to Diamond NestEgg, we appreciate you too. And welcome to the #1 place to learn about money, investing, and retirement. I'm Jennifer, and I've spent most of my life in finance. Started working at banks like JP Morgan and Goldman Sachs at the age of 17 and graduated top of my class from NYU and Harvard Business School studying finance and business. And now I work with companies like Bloomberg, WeWork, and Walker Edison, teaching their employees all about financial literacy and wellness. Please note that Diamond NestEgg is a financial literacy, education, and coaching company, and that I'm a licensed life, disability, and health insurance broker. We are not a bank, securities broker, legal, tax, or financial advisor. Some quick basics first for those of you new to annuities. An annuity is a contract between you, the owner, and an insurance company. Whereas life insurance protects your loved ones upon your death, an annuity protects you and provides you with a recurring income, a regular monthly paycheck, while you're still alive. It provides income generally during retirement, and it provides this income for a specific number of years, or in the most ideal situation, for your entire life post-retirement, so you don't outlive your money. In the simplest terms, think of an annuity as a way of giving yourself a steady income in your later years when you're no longer getting a regular paycheck from work, typically from age 59 and a half, so that you don't incur any withdrawal penalties from the IRS. Take a look at our annuity videos here to learn who would buy an annuity, how an annuity might fit into your overall retirement planning strategy, as well as the pros and cons of buying an annuity. Now, let's move on to today's topic, the different types of annuities. There are 3 different types: fixed annuities, indexed annuities, and variable annuities. Remember that an annuity is a tax-deferred investment vehicle, like your company 401k or personal IRA, meaning that you don't pay taxes on the money that grows in the annuity. You're only taxed when you take money out of your annuity, meaning when you start getting your monthly payments. The 3 different types of annuities, fixed, indexed, and variable, share this similarity. They are all tax-deferred investment vehicles like your 401k and IRA, but each type of annuity comes with a different level of risk and reward. A fixed annuity promises a guaranteed minimum return, a minimum interest rate, and regular payments that do not change from one month to the next. The insurance company essentially promises to pay you that specific minimum amount every month for as long as agreed upon in your annuity contract. This can be for 10, 15, 20, or more years, or for the rest of your life, so you don't outlive your money. Because as we've mentioned before, running out of money is the biggest retirement worry for nearly everyone. While there is a guaranteed minimum interest rate with a fixed annuity, this interest rate can change over time. Whether, how, and when this can happen is explained in your annuity contract. Typically, the interest rate on a fixed annuity is fixed for a number of years and then changes periodically based on the then current interest rates. As you put your money into a fixed annuity, and it's growing in there, so basically before you get your monthly payments out of the annuity, the insurance company will invest your money, mostly in conservative investments like high-quality corporate and government bonds. And the insurance company will give you the guaranteed minimum interest rate as detailed in your annuity contract, or the then current interest rate, whichever is higher. The minimum interest rate is the lowest rate that your money can earn. With a fixed annuity, the insurance company bears the investment risk. Even if interest rates drop below the guaranteed rate, the insurer must pay you the guaranteed rate amount. But as I've said before, this guarantee is only as good as the insurance company behind it. That's the reason why we only work with the best of the best in the insurance business, Guardian and MassMutual. Guardian was founded in 1860 and MassMutual in 1851. That's before Alexander Graham Bell invented the telephone and before Henry Ford invented his first car, the Ford quadricycle runabout. Wowzers for Guardian and MassMutual. Both Guardian and MassMutual receive high ratings for financial strength from the largest independent ratings agencies. and they've paid out dividends to their policyholders consistently over the years. In 2021, Guardian's dividend rate to policyholders was 5.65% and MassMutual's 6%. Anyway, in addition to the insurance company bearing the investment risk, the charm of a fixed annuity lies in its predictability and the peace of mind that comes with it. You know that you're getting paid a guaranteed minimum amount each month, and that it's stable, and that you won't ever lose the money that you put into it if you hold on to the fixed annuity for as long as you agreed to in your contract. A fixed annuity is the lowest risk option, but on the flip side, it's also the lowest reward when compared to an indexed or variable annuity, with returns currently hovering on average around 3%. But this can vary quite a bit depending on the insurance company you work with. If you want to see if we can customize an annuity for you or a loved one, and to see what rates would look like, drop us a note at jennifer@nestegg.com or on Instagram. Another disadvantage of a fixed annuity is that it doesn't take inflation into account. Inflation is when the price of everyday items goes up, as they are currently. Your monthly payment still stays the same, meaning in the long run, you're able to afford less and less. There is a cost of living rider that you can add onto a fixed annuity for an additional cost that will adjust for the inflation factor. But we'll get into annuity riders in another video. That's a fixed annuity. Now let's move on to the indexed annuity. An indexed annuity is essentially a fixed annuity, so you get a guaranteed minimum return, but your monthly payments do change because an indexed annuity is tied to what? An index, of course. With a fixed annuity, the insurance company invests the money into high-quality conservative corporate and government bonds. With an indexed annuity, the money is placed into a standard market index, and the most common one that is used is typically the S&P 500. To learn more about indices, you can check out our video here on mutual funds versus index funds versus ETFs, and skip to the index fund section. The goal of an indexed annuity is to be able to keep the predictability and peace of mind that comes with a fixed annuity via that guaranteed minimum return, that guaranteed minimum interest rate, while still capturing some of the upside of potential market increases. So if the market goes way up, your payment also goes up way beyond the guaranteed minimum rate. Typically, the insurance company will reserve the initial returns for themselves, but pay the excess to you. So what does that mean, right? Let's use Guardian as an example. And let's say you buy an indexed annuity from Guardian with a guaranteed minimum interest rate of 3%. No matter what happens, even if the S&P 500 completely tanks, you'll still get your minimum guaranteed interest rate of 3%, like with the fixed annuity. Unlike the fixed annuity, if the S&P 500 soars, Guardian may keep the first 3% earned for themselves, but anything in excess of 3% will be passed onto your indexed annuity account. So, if the S&P 500 index goes up 10%, Guardian would keep its 3% and you would get the remaining 7% instead of your guaranteed minimum interest rate. Most index annuities do have a rate cap. This means that your total annual rate of return is capped at a percentage. If your annuity has a 7% rate cap, you would be capped at 7% regardless of how high the S&P index skyrockets. Generally speaking, on the risk versus return spectrum, we'd say that an indexed annuity is low risk, like a fixed annuity, assuming you go with a financially strong insurance company. So an indexed annuity is low risk with medium return. So why wouldn't folks just go for an indexed annuity all day, every day, given that you get all the pluses of a fixed annuity plus a higher return? Because an indexed annuity is more expensive than a fixed annuity. An indexed annuity is a more complex financial instrument, and with complexity comes costs. Typically, the more complex an annuity is, the higher the fees and commissions will be. So as always, you need to weigh out whether the costs are worth it, which a good life insurance agent who understands your full financial picture will be able to do. You should always have a good feeling about your life insurance agent, and this person should always know the ins and outs of your finances. So if you're working with someone that doesn't truly understand your numbers, or that you have even the slightest inkling of doubt about, it's probably time to consider shopping around for another life insurance agent, whether that's us or someone else you know. Do remember that the money you put into a fixed or variable annuity is in most cases illiquid for a number of years and should not be withdrawn before age 59 and a half. Otherwise, you'll have to pay to the IRS a 10% early withdrawal penalty on any money you take out, plus any regular taxes due on that money. And you'll also have to pay early withdrawal fees, known as surrender charges, to the insurance company. Take a look at our video here to learn more about the illiquid nature of annuities and the fees and penalties that come with early withdrawal from an annuity. Right, so far we've talked about fixed annuities and indexed annuities. Next in line is the variable annuity. For those of you who have watched our annuity intro here on who buys an annuity, you may recall that I said one of the great things about an annuity is that you never lose the payments you put into it, what's known as your principal. So if you make monthly payments totaling $200,000 into your annuity, you should get back at least the $200,000 you put in, with two exceptions. The variable annuity is one of those exceptions. You can think of a variable annuity as the exact opposite of a fixed annuity. Whereas the fixed annuity offers you a guaranteed minimum return, a guaranteed interest rate, and a predictable income stream, a variable annuity does not guarantee a minimum return nor a predictable income stream. Payments can change month to month, and if the markets take a dive, you could end up losing money in the long run. Your principal, the money that you originally put in, is not guaranteed. With a variable annuity, you pick from a menu of investment options pre-selected by the insurance company. This menu could have 10 investment options on it, or it could have 40 investment options or more. Think of it a bit like choosing the investments in your company 401k or investing in mutual funds via your broker. So, if the market booms, your return could also skyrocket way beyond what you would get with a fixed or index annuity. On the other hand, if you choose some really bad investments in your variable annuity, you could end up with less money or even way less money than you put in initially. Having said that, you can still make sure that you get a predictable monthly income from a variable annuity by tacking a rider onto it at an additional cost. But we'll talk about this in a later video on the most common annuity riders. A variable annuity is high risk, with the potential for higher return than with a fixed or index annuity, if markets are booming. But remember, you have to choose the investments in your variable annuity wisely. This comes with additional responsibility, effort, and complexity. And as I mentioned earlier, the more complex an annuity is, the more in fees you will have to pay. A variable annuity generally charges anywhere between 3 to 4% of your account value annually, which typically includes investment advice and management and optional fees. Compare this to an index annuity, which charges around 1%, or a fixed annuity, which charges less than that. In fact, many financial experts argue that the high fees associated with a variable annuity make it an inherently poor choice of annuity. Our take on the variable annuity? Assuming you have other retirement assets, life insurance, and savings. You can take a look at our life insurance videos here to learn more about building cash value and generational wealth with whole life versus term life, and the importance of buying life insurance when you're still young and healthy. So as I was saying, assuming you have other retirement assets, life insurance, and savings, the whole point of an annuity is then to complement what you have by offering a steady stream of income. Basically, financial stability and predictability in retirement, which really isn't the time to be throwing your money into higher risk stuff, especially when there are all these fees involved with a variable annuity. But as our trademark saying goes, everyone's financial journey is different and everyone's risk-return profile is different. And not everyone has a complete portfolio of retirement assets, life insurance, and savings. Drop us a note on jennifer@nestegg.com or on Instagram if you're interested in discussing the annuity, life insurance, and retirement options available to you. So to recap, a fixed annuity is the most predictable with a guaranteed rate of return and payments that do not typically change over time. It's low risk, low reward, but also comes with the lowest fees. An index annuity gives you the same safety net of a fixed annuity with its guaranteed rate of return, but allows you to capture some upside in the market via its indexing feature. If the market index goes up, your payments go up. If the market index goes down, you still have your minimum monthly guaranteed paycheck. It's low risk, medium reward, but comes with higher fees than a fixed annuity. And with a variable annuity, that's at the opposite spectrum of a fixed annuity. There is no guaranteed rate of return and no predictability in monthly payment amounts. If the investments you've chosen for your annuity go up, your monthly payments go up. And if they go down, your payments go down. On the risk-reward spectrum, it's high risk, high reward, and also comes with the highest fees relative to a fixed annuity and an index annuity, which is why you should be really careful and work with a trusted life insurance agent before buying one of these. You know how to reach us if you need us. Thanks for watching, guys. We really appreciate all of your support. If you enjoyed this video, please give us a thumbs up and hit that subscribe button. Next week, we'll be talking about the different ways you can customize your annuity, regardless of whether it's a fixed, indexed, or variable one. See you then.